China shuts down paper gold. July 24th, and veteran strategist Michael Pento just said something that should stop every serious investor cold. This could collapse the Western gold market. Not shake it, not pressure it, collapse it. For decades, the West has priced gold on paper promises, promises that may no longer hold. China just proved that. And in this video, the exact mechanism behind that warning, the data nobody in mainstream finance is discussing, and the historical precedent that shows exactly where this leads next. Stay until the end, because what happens in part 2 changes everything you think you know about the gold market. Welcome back to Currency Arc Insight, the channel built for serious investors and business minds who refuse to be blindsided by the next economic shift. Hit subscribe right now if you want the warnings that matter before they hit the mainstream, and drop a comment below telling us which city or country you're watching from today. Let's get into it. On July 24th, China made a move that most Western investors never saw coming. The country shut down paper gold trading through 5 major banks, cutting off a system that millions of retail traders had used for years. Michael Pento, a veteran macro strategist, called the decision enormous. He said it could break the Western gold market. Not damage it, not slow it down, break it. To understand why this matters, people first need to understand what paper gold actually is. When most investors buy gold, they assume they are buying real physical metal sitting in a vault somewhere. In reality, most gold trading around the world does not work that way. Instead, banks and exchanges sell paper contracts. These contracts represent a claim on gold, but they are not backed by actual metal sitting in storage. Traders can buy and sell these contracts using a small deposit, controlling a position far larger than the cash they actually put down. This is called leverage. For decades, this system worked fine. Nobody demanded to see the real gold because everyone trusted that the paper contract was just as good as holding the metal itself. China's central government decided that trust was no longer good enough. In the months leading up to July 24th, Chinese regulators started raising margin requirements on gold traders. At one point, the requirement reached 140%. That means a trader would need more money as collateral than the actual value of the position they were trying to control. For most retail traders, that made the entire system impossible to use. Positions were forced to close. Then, on July 24th, China went even further and shut down the specific leveraged contracts entirely on the Shanghai Gold Exchange. These were called IAU Plus contracts, and they allowed people to control large gold positions using very small deposits. China essentially said this structure was too risky and too disconnected from real physical gold, so they ended it. Here's why this should matter to every serious investor in the West, not just people in China. The exact same structure exists in the United States and in London. COMEX in New York and the LBMA in London are the 2 institutions that set the global price of gold every single day. Both of them run on paper contracts that vastly outnumber the actual physical gold available for delivery. Traders control massive positions using deposits that represent only a small fraction of the real value. China just declared that this exact structure was unacceptable within its own financial system, and they shut it down completely. This is where Pento's warning becomes serious. He's not simply reacting to a policy change in China. He is pointing to a much bigger question. If China believes paper gold without physical backing is too dangerous to allow, what happens when the rest of the world starts asking the same question? The entire Western gold market depends on one quiet assumption that has never really been tested at scale. That assumption is simple. Paper gold and physical gold are treated as if they are equal in value and equally reliable. As long as nobody tries to cash in all their paper contracts for real metal at the same time, the system works smoothly. But China's move removes one of the largest retail paper gold markets in the entire world. Millions of traders who once used these leveraged contracts now have to either walk away or shift toward demanding real physical gold instead. That shift matters more than most people realize. When paper contracts disappear and demand moves toward physical metal, the pressure on the physical gold supply increases. Physical gold cannot be created instantly. Mining takes time. Supply grows slowly, usually only 1% to 2% per year. So if a large group of buyers suddenly wants real metal instead of paper promises, the system has to adjust. Prices move to reflect the new reality. This is exactly the kind of pressure Pento is warning about. Not a sudden crash overnight, but a structural shift that begins quietly and builds over time. China did not just close a domestic trading program on July 24th. They challenged a core assumption that Western gold pricing has relied on for decades. And according to Pento, the consequences of that challenge could be enormous. In the next part, the story turns to a real event that already happened once this year, one that shows exactly what happens when paper promises stop matching physical reality. Before anyone dismisses Pento's warning as an exaggeration, they need to look at something that already happened in 2026. It did not happen in some distant history book. It happened just months before China's July 24th shutdown, And it happened in a market that operates almost exactly like gold. That market was silver. In January 2026, something strange occurred that most financial news outlets barely covered. Physical silver, the real metal that people could actually hold in their hands, started trading at a price nearly 40% higher than paper silver contracts. For a market that is supposed to move as one unified price, a 40% gap is not a small glitch. It is a warning siren. Here is what caused it. Demand for real, physical silver surged. Buyers wanted actual bars and coins delivered to them, not paper promises sitting on a bank's balance sheet. As that demand grew, confidence in paper silver contracts started to weaken. People no longer fully trusted that a paper claim on silver could be treated the same as owning the metal itself. So they were willing to pay a premium, a much higher price, just to get their hands on the real thing. This is not a theory. It is confirmed market data from one of the most heavily traded commodities in the world. Now, consider what this means for gold. Gold and silver share the same basic market structure. Both trade through paper contracts that vastly outnumber the physical metal actually sitting in vaults. Both allow institutions and traders to control huge positions using a small fraction of real money. And both depend on the same fragile assumption that paper and physical are worth exactly the same thing at all times. When that assumption held strong in silver, everything looked stable. But the moment real demand for physical metal spiked, that stability cracked. Paper silver could not keep up with the trust placed in it. The gap widened, and the market was forced to reveal the truth. Physical metal was worth more than the paper claiming to represent it. Gold is a much bigger market than silver, roughly 8 times larger by total value. That means the stakes involved are far higher. If the same kind of confidence crack happens in gold that happened in silver, the consequences will not be small. They will ripple through global markets that depend on gold as a foundation of financial stability. And here is what makes this moment even more serious. Even before China's July 24th shutdown, the paper gold market was already showing signs of weakness. Hope and interest on COMEX, which measures how many active paper contracts exist, had fallen to levels not seen in roughly 17 years. That means fewer traders were participating in the paper gold system than at almost any point in nearly 2 decades. At the same time, Western gold ETFs saw significant outflows with roughly $3.6 billion leaving Asian-linked funds in just 2 months during May and June of 2026. In simple terms, people were already pulling back from paper gold before China made its move. The system was thinning out. Trust was quietly eroding. And then China removed one of the largest retail paper gold markets in the entire world in a single decisive action. This is the transmission effect Pento is pointing to. It is not a random prediction pulled out of thin air. It is a pattern that already played out once this year in a closely related market. Silver showed the world what happens when physical demand outpaces confidence in paper claims. Gold is now facing the exact same pressure, but on a much larger scale, and with one of its biggest paper markets suddenly gone. Think of it like a dam holding back a river. For years, the dam held steady because the flow of water matched what the structure could handle. But when the water level rises faster than expected and cracks start appearing quietly along the base, the dam does not need to collapse instantly to become dangerous. It just needs enough pressure building in the right place at the right time. Silver showed the first crack in January 2026. China's July 24th shutdown removed a support beam from the gold side of the same structure. Investors and business leaders paying close attention right now are asking a simple question. If paper markets already cracked once under pressure this year, what happens next as physical demand for gold continues rising while paper participation keeps shrinking? The next part of the story turns to something even bigger than silver or gold alone, a pattern in American financial history that has not existed in this form for more than 50 years, and why some strategists believe it dramatically raises the stakes of everything happening right now. To understand why Pento's warning carries so much weight, people need to step back from gold for a moment and look at the bigger picture of the American economy in 2026. Because gold rarely moves in isolation. It responds to pressure building elsewhere in the financial system. And according to Pento, that pressure is coming from 3 directions at once. He calls it the triple bubble: credit, real estate, equities, all 3 inflated at the same time, all 3 vulnerable at the same time. Start with credit. Total debt across the American economy has climbed to record levels when measured against the size of the entire economy. This is not a small or temporary increase. It is a structural buildup that has been years in the making. When debt grows faster than the economy, producing the income to service it, the system becomes fragile. Even small shocks can cause outsized damage. Next comes real estate, especially commercial real estate. Office buildings, retail spaces, and commercial properties are under serious stress as remote work continues to reshape how businesses use physical space permanently. Demand for many types of commercial property has weakened, and valuations built during a different economic era are now facing a harsh reality check. Then there's the stock market. Equities are trading at valuations that are historically high when measured against long-term earnings. The S&P 500 has been trading above 22 times forward earnings, a level that history shows is rarely sustainable without eventual correction. Individually, any one of these conditions would be worth watching closely. Together, all three at once, Pento argues, this creates a systemic fragility that is more dangerous than what caused the 2008 financial crisis. In 2008, the primary danger was concentrated mostly in real estate and mortgage-backed securities. Today, three major pillars of the economy are under pressure simultaneously, something with no clear modern precedent. This creates a serious trap for the Federal Reserve. If the Fed raises interest rates to fight inflation, it risks popping both the credit bubble and the real estate bubble at the same time. If the Fed cuts rates to support growth, inflation could accelerate, and the value of the dollar could weaken further. If the Fed simply holds rates steady and waits, the economy slows down while the cost of servicing all that debt keeps climbing. There is no clean way out. Every option carries a serious cost. This is exactly the kind of environment where gold has historically played a critical role, not as a source of excitement, but as a form of protection. To understand why, it helps to look back more than 50 years to a moment that reshaped how gold behaves in the modern financial system. In August 1971, President Nixon made a decision that changed everything. He ended the direct convertibility of the American dollar into gold, a policy that had kept gold's price fixed at $35 per ounce under the Bretton Woods International Monetary System. Before that moment, gold could not move freely. Its price was locked in place by international agreement. After Nixon's decision, gold was finally allowed to trade based on real supply and demand instead of artificial fixed pricing. What happened next reshaped financial history. By January 1980, gold had climbed to $850 per ounce. That is an increase of roughly 2,400% from its previous fixed price. Once the artificial restraint was removed, gold's true value reasserted itself in a powerful and undeniable way. China's July 24th shutdown may not be identical in scale to Nixon closing the gold window in 1971, but the underlying pattern is strikingly similar. In both cases, an artificial layer suppressing gold's true price discovery was removed. In 1971, it was a fixed exchange rate holding gold artificially low. In 2026, it is the removal of a major paper gold market that had been masking real physical supply and demand. History shows that when these kinds of artificial barriers come down, gold does not adjust quietly. It repriced dramatically after 1971. And now, with a triple bubble economy putting pressure on credit, real estate, and equities all at once, the conditions for gold to play its traditional role as a safe haven appear stronger than they have been in decades. Business leaders and serious investors watching this unfold are beginning to ask an important question. If the Fed has no clean exit from this trap, and if history shows what happens when artificial gold price suppression gets removed, what role should gold be playing in a well-prepared financial strategy right now? The next part of the story turns to what China has been doing quietly behind the scenes for nearly 2 years, a coordinated strategy that connects directly to everything unfolding in this triple bubble economy. Everything discussed so far might look like a string of separate events: a shutdown in China, a strange premium in the silver market, a fragile American economy carrying three bubbles at once. But when these pieces are placed together, a much bigger and more coordinated picture starts to appear. For nearly 2 years, China's central bank has been quietly and steadily buying gold. According to official reserve data, the People's Bank of China has added to its gold holdings for 19 consecutive months without a single pause. This is not random buying. It is a deliberate, sustained strategy carried out with remarkable discipline. Then, just weeks before the July 24th shutdown, Hong Kong launched a new physical gold clearing system. This system is built specifically to handle real, verified physical gold rather than paper claims. The timing matters. It was introduced only 17 days before China shut down its leveraged paper gold contracts on the mainland. When these events are placed side by side, a pattern emerges. First, steady accumulation of physical gold for almost 2 years. Then, the launch of new infrastructure built specifically for physical gold settlement. And finally, the shutdown of paper gold trading that had allowed synthetic exposure without real metal backing. These are not three unrelated decisions. They function as one coordinated strategy, executed in careful sequence. At the same time, physical demand for gold has been reaching record levels around the world. Central banks purchased around 244 tons of gold in the first quarter of 2026 alone, according to World Gold Council data. That figure was already 17% higher than the previous quarter, which itself had been strong. Meanwhile, individual investors purchased physical gold bars and coins at a pace of 474 tons in the same quarter, the second highest level ever recorded. Altogether, total physical gold demand reached a value of roughly $193 billion in just 3 months, an all-time record. At the exact same moment, participation in paper gold markets in the West has been shrinking toward levels not seen in 17 years. Physical demand is at record highs. Paper participation is near multi-decade lows. This is one of the widest gaps between physical strength and paper weakness ever recorded in the gold market. This is the environment China's July 24th shutdown stepped into. Not a calm, stable market, but one already stretched thin on the paper side, while physical demand kept climbing steadily in the background. Major financial institutions appear to be paying close attention to this shift. JP Morgan's precious metals team maintained a gold price target of $6,000 for the end of 2026, holding that position even through a sharp 28% price correction earlier in the year. Goldman Sachs, separately, maintained a long-term target of $8,000 for gold by 2030, without revising that number even once during periods of market weakness. These targets were set while the paper gold system was still fully intact. With one of its largest paper markets now removed, some analysts are beginning to ask whether those targets may prove conservative rather than aggressive. History offers a useful lesson here. Every major gold correction in the modern bull market has eventually been followed by new record highs. After a 34% correction in 2008, gold recovered and rose to $1,120 by 2011, a gain of roughly 170% from its low point. After a 45% correction beginning in 2011, gold eventually climbed to over $5,000 by early 2026, a gain of more than 400% from its low. Each time paper markets absorbed pressure and adjusted, physical gold demand continued building quietly underneath. Pento's warning was never about predicting an overnight collapse. It was about identifying the direction of travel, and the data now supports that direction clearly. Paper participation is fading, physical demand is climbing, sovereign accumulation is steady and coordinated. And one of the largest retail paper gold markets in the world has just been removed entirely. For business leaders and serious investors, the message is not one of panic. It is one of positioning. Markets rarely announce turning points in advance. They reveal them gradually, through data most people overlook, until it becomes impossible to ignore. China's July 24th shutdown may be remembered as one of those quiet turning points, the moment the foundation beneath the Western paper gold market became measurably weaker. The direction is now visible. What each investor decides to do with that information is the only question that remains.